Hello, my name is John Miares, and I am a survey statistician and group leader in the USDA NASS Great Lakes Regional Field Office in East Lansing, Michigan. In this presentation, I want to spend some time talking about Section H of the ARMS 3 questionnaire, which covers operating and capital expenditures for the farm or ranch operation. Now, my focus here is going to be on the cost and returns report, also known as the CRR or version 1 of the ARMS 3 report. Each version of the questionnaire will contain the core questions we will be reviewing here, but each commodity-specific version will also contain some expense questions that are tied specifically to the commodity of interest. Those differences will be discussed in separate presentations. Additionally, while this video will cover highlights of this section, it is by no means a replacement for a thorough review of the interviewer's manual or working with your supervisor. For this presentation, I would recommend that you have a copy of the version 1 questionnaire handy and turn to the beginning of Section H. Data gathered in this section are used to estimate the producer's costs of doing business. These estimates are critical indicators to the health of the farm economy. They also provide a basis to track costs over time, which provide useful insight into issues faced by those in the farm community. Estimates derived from this section are used in USDA reports and are included in the Farm Production Expenditures Report published by NASS every August. This publication also gives the first indications of how you can break out farm expense information by farm characteristics, in this case, by size and type of farm. This ability is one of the most important things that ARMS allows us to do beyond simply reporting the results by item. Information from this section are also used to provide annual weights for NASS's computation of prices paid indexes, a component of the calculation of parity prices required by the Agricultural Adjustment Act of 1933. The prices paid indexes are also used in the calculation of depreciation and forecasting of expenses. The data are also used by the Bureau of Economic Analysis, or the BEA, to prepare national estimates of gross domestic product. Finally, they're also used by the USDA Office of the Chief Economist, whose Office of Energy Policy and New Uses pays close attention to the volume and the cost of fuels by type on farms and ranches. As has been discussed in other presentations, ARMS is intended to provide an economic snapshot of the state of the family farm. Up to this point, this form has focused on the types of revenue or income received or expected by the operation during the calendar year. Data gathered in Section H are used to estimate expenses, which represent producers' costs of doing business. These estimates are critical indicators to the health of the farm economy. They also provide a basis to track costs over time, which provide useful insight into issues faced by those in the farm community. Together, with income information collected in earlier sections, we are able to generate indications of farm income, which in simplest terms means gross farm receipts minus farm expenses. Not too long ago, each question in this section was broken down into 3 parts, recognizing that the total expenses incurred by the operation may have been paid by producers, landlords, or contractors. Now, most of these questions in this section focus on items spent by producers and their partners. Specific expenses most likely to be paid by landlords are now asked at the end of Section H, and questions about contractor expenses were removed entirely from the form. Contractor expenses are still calculated behind the scenes, but are based on data collected on a separate survey of just contractors. If possible and where appropriate, please write detailed notes about the type and amount of services that are provided by a contractor. When collecting data in Section H, Be sure to report only expenses for the targeted operation. That is the operation defined by the total acres recorded in Section A, Item 4. This section has a lot of detail and a lot of include, exclude instructions. These are important, but don't get bogged down by them. Do your best to find a place to record any of these expenses and then just leave comments if you're unsure or if you have a unique situation. Finally, if the respondent can't give you an exact figure, try to get the best estimate or a percentage used and make a note to help explain the situation. Section H is separated into 3 parts. Questions 1 through 34 on the CRR focus on operating expenses, which include expenses related directly to the day-to-day operation of the farm business, such as those shown on this slide. Operating expenses typically include the sum of the cost of goods and services, which include the cost of labor, input, and materials used, as well as the portions of overhead related to production, combined with the costs associated with selling agricultural products, general and administrative expenses, and depreciation expenses. Household and personal expenses are not included here, even though for some operations, off-farm income is used to pay for on-farm expenses. We also want to exclude expenses associated with performing custom work for other operations, especially if a separate set of books are used for the custom business. Also, we should exclude any expenses paid by the producer acting as a landlord on land that is rented to others. Why are we collecting these farm production expenditures in such great detail? This is going to ensure that no data is going to be omitted, particularly items not typically found in record books. We know that if we do not ask for costs by item, respondents will fail to report some expenses and leave out some costs that would make net income appear larger than it should. Also, detailed expenditures allow USDA to compare and quantify item by item cost per unit indicators. Examining expenditures this closely improves the quality of estimates of expenses. The first 3 questions in Section H ask about expenses for seed, fertilizer, and chemicals purchased during the reference year, regardless of when the input is used. Operations often pre-purchase items such as seed, fertilizer, and fuel during the fall for use during the following year. Please write notes if an operator reports unusually high expenses for this year for items that would not be used until next year. At the same time, if any of the inputs for this year were purchased last year, they should not be included as part of the current reference year's expenditures. Keep in mind that just because an operator purchased these inputs doesn't mean they were all necessarily used. After all, an operation may have purchased these items intending to grow a certain number of acres of crops that may never have gotten planted for one reason or another. The expense doesn't change, but the operator may then record those unused items as part of the end-of-year assets in Section I. Conversely, if an operator reports unusually low expenses for these items this year, ask if any of these items were purchased the prior year, and then be certain that the value is recorded as a beginning of year asset in Section I. Questions 4 through 8 address expenses that are unique to operations with livestock and should be present if there are livestock inventories reported in Section C. For example, if the operator owns and raises hogs, you might expect to see responses to questions 4A or 4B, question 6, or question 8. Other expenses may also apply. When recording livestock purchases in item 4, be sure to include the price of the animals plus commission, yardage, insurance, and fees. In question 9, we are asking the operator to break down all fuel purchases by different fuel types. Farm record books and the IRS Schedule F will usually have an entry for total gasoline, fuel, and oil, but will not follow the breakdown we're asking for in Section H. If the operators cannot break down the individual fuels by dollar amount, try to have them break it down by percentage. Also, be sure to include only the farm share of the fuels. Any fuel purchased for personal vehicles should be excluded. Finally, double check that the total amount spent on fuels on the top line with item code 663 is the sum of all the different fuel types below. This has been a very common recording error over the last several years. The next several questions are tied to other operating expenses of the farm or ranch, including electricity and other utilities for the farm business, purchased water for irrigation, insurance for the farm business, including crop insurance, interest and fees paid on debts, property taxes paid on real estate, livestock, machinery, or other farm production items, equipment rental, storage rental, vehicle registration, and depreciation expenses. A few items that have been misreported in the past are associated with items 13 through 15, which ask about farm supplies, repairs, and maintenance of farm buildings. The questionnaire provides a brief description of these items, and the interviewer's manual provides a more extended description. For each instance, we want the farm share of the expense. But sometimes it's difficult to separate the farm share versus the household share. If they're not listed separately in the operator's records, family use expenses can be included here in Section H, but be sure not to duplicate those expenses under household expenses to be recorded in Section M. Another question where the line can be blurred between a farm expense and a household expense has to do with repairs to the operator's home recorded in question 16. As a general rule, if the operator's house is owned or can otherwise be declared as an asset of the farming operation, then any repairs to the dwelling can be reported here. However, if the operation is structured in such a way that the home is separate from the farm business, then any repairs to the house should be reported in Section M. Questions 24 through 27 ask about expenses associated with wages, payroll taxes, and benefits for hired labor for the farm or ranch. Please note that question 25 asks for a breakdown of total wages reported in question 24, similar to the way the fuels are broken down in question 9. Paid labor includes only those workers whose pay was considered a business expense of the farm during the year. These workers should have gotten a W-2 or a 1099, but they might not have, depending upon the arrangement the worker has with the operator. The table above question 24 has some detailed instructions as to what to include and exclude regarding cash wages. In short, if wages were paid, they should be included. However, there are some notable exceptions. For example, wages that were paid for workers at a roadside stand or at a farm store should be excluded unless than 50% of what is sold there was produced on the farm. You also want to exclude work provided by service firms such as commercial bookkeeping, legal or professional services, and items like that. Those can be included in question 32. Also, if the operator or partners are taking draws from the operation for personal expenses rather than collecting a wage that is accounted for by a W-2 or a 1099, those should be excluded as well, as those items are closely linked to items to be recorded in sections K, L, and M. Several more operating expense questions follow, including expenses for contract labor, custom work, non-cash payments for farm work, which follow directly from the higher labor questions that immediately precede them. Also asked are questions about the market value of commodities produced and used on the operation for home consumption, then professional and farm management services, and general business expenses. One item historically overlooked and underreported are marketing and storage expenses in question 34. Almost all operations that sell commodities have marketing expenses. All marketing expenses paid for by the operator for the sale of products must be included. Checkoff fees, commercial crop drying, sales commission fees, inspection fees, storage fees and expenses, transportation, yardage fees should be included even if the crop is not yet sold. If a commodity was not sold from storage but returned to the operation, out-of-pocket expenses for storage should be included as a marketing expense. If an operator reports no marketing charges, probe to find out if anything was subtracted out of the total price before a farmer received a check for sold goods. In many states, certain checkoff fees are standard for all operators. If you can get a total quantity and units sold of a particular commodity, statisticians in your regional field office may be able to derive an estimate for marketing charges such as checkoff fees and commissions. There are a handful of operating expenses that are collected elsewhere on the questionnaire. The first and most notable items include components for gross rent, including cash rent, share rent, or grazing fees reported in Section A. Although this was discussed in an earlier presentation, it's important to note the differences in collection of rent expense from previous years. It used to be that the landlord's share was a column in field crop production and separate cells in other types of commodities. Now that the question is collapsed into one cell for every type of share rent, it's important to obtain a full accounting of the landlord's share, especially for crops. As I said before, respondents tend to underreport amounts when items are reported in a single cell rather than having them broken out over several cells. The other notable operating expense not included in Section H includes the livestock contract production fees accounted for in Sections D and E. Livestock contract production fees are both income to the operator and an expense to the contractor. So the value is used in two different ways, so it's important to get it right since contractor expenses tend to be a $6 billion item annually nationwide. The second part of Section H looks at capital expenditures. Certain assets which give a long-term benefit to the farm, such as equipment and buildings, can be depreciated over the useful life of the asset, which is generally 2 or more years. Purchasing these assets is considered a capital expense in contrast to operating expenses, which offer a shorter term benefit and are therefore written off immediately. Examples of capital expenses may include the purchase of a new tractor or equipment or major repairs to buildings. If an operator places an expense on a depreciation schedule, it should be recorded as a capital expense and accounted for as an asset of the farm or ranch business. One exception I want to note is that land purchases for expanding the operation are going to be considered capital expenses for the purposes of this survey, even though land is not considered a depreciable asset. The first few questions focus on what could be called capital improvements. These are expenses taken on by the operation with the goal of adding value to the farm assets and business. These could include improvements to the land, such as irrigation improvements, well drilling, or fences, new construction and remodeling of dwellings and buildings, including livestock buildings and storage facilities, and new construction or remodeling of the producer's dwelling if it's owned by the operation. As a reminder, Any new construction or remodeling of the producer's dwelling should be excluded if the home is not listed as an asset of the farm or ranch operation. The next several questions focus on vehicles, machinery, and equipment purchased for the operation. Question 42, regarding expenses for all-terrain vehicles, side-by-sides, and utility task vehicles, is now its own question. In previous years, expenses for these types of vehicles were included with what is question 46 that asks about all other capital expenses. It's important that the operator be able to distinguish assets that are used in other businesses and the operator's household. For example, with automobiles and trucks, a specific question is asked about the percent use on the farm for those vehicles. It might be reasonable to expect that a car might only have 40% farmer ranch use and a truck only 80% farmer ranch use. If the farmer ranch use for either of these items is 0%, then the expense should be included as a household expense in section M and not a capital expense for the farm in section H. Similarly, if the operator runs a separate custom work business, perhaps a business for custom spraying, harvesting, or hauling, then the amount of a purchase that would be reported for tractors or self-propelled equipment or other farm machinery would need to be prorated between the farming operation and the custom work business. Here's a case where we may have to probe carefully to determine where the expense should be recorded. Suppose an operator spends $25,000 to overhaul the transmission of a tractor. If the expense was listed on a depreciation schedule, then we can count it as a capital expense, and we would record it in item 46, all other capital expenditures. However, if the cost was not listed on the depreciation schedule or it was expensed, then it should be recorded in the repair and maintenance of machinery and farm equipment question, which is question 14. Again, the principal determinant of whether an expenditure is a capital expenditure is whether or not it is placed on the business's depreciation schedule. Whatever we do, we don't want it listed in both places. Questions 46 and 47 serve as a catch-all to account for other expenses that weren't previously itemized in the section. While question 46 focuses on previously unlisted capital expenditures placed on a depreciation schedule, question 47 focuses on production expenses that might not have been accounted for anywhere else in section H. Be sure to specify what the expense was for and add comments regarding unusually large expenses, especially if you're not sure if it should be counted as a production expense or a capital expense. It's possible upon further review, we might be able to account for those expenses somewhere earlier in section H under a different question. However, for some items like potting soil or vermiculite used by nursery and greenhouse operations, these questions might be the only place in section H where we can record that expense. The last 6 questions focus on expenses that might be paid by landlords as part of a rental agreement. If the primary producer is not renting any land, then these questions can be skipped. Some landlord expenses may be difficult for the operator to know, but approximations or even just knowing that the landlord paid certain expenses would be helpful to know. For example, all landlords should have property tax expenses. If the property taxes are paid for by the producer as part of the rental agreement, though, please write a note to explain the situation. Now, a word of caution. It is possible that the target is renting land to others, which by definition makes the target a landlord. However, we do not want to include any expenses made by targets in their capacity as landlords on land rented to others. We only want to record expenses that would be paid by this operation's landlord on land that was rented from others. I'd like to take a few minutes to look at some of the data relationships you should expect to see in this section. Once you learn what the farm or ranch's chief commodities are in the early sections of the questionnaire, you'll want to make sure that particular expenses you would expect to see for that farm or ranch are accounted for. For example, crop farms are typically going to have expenses for seed, fertilizer, chemicals, and fuel each year. Labor expenses may depend upon the size and the structure of the operation, and rent expenses will be dependent upon whether parts of the operation are rented from others. Livestock operations would be expected to have expenses shown here, although the amounts could differ depending upon the structure of the operation. For example, if an operation produces its own feed, then the feed expense may be low. If an operation already has its own breeding stock, such as a commercial dairy or a farrow to finish hog operation, the amount of livestock purchased may not be significant. Notes should be recorded when these expenses are unexpectedly low. Nursery and greenhouse operations have many of the same expenses as crop operations, but in different proportions. For example, utility and labor expenses tend to be much higher than other farms with similar values of sales. Additionally, greenhouses would have higher charges for marketing containers, which would be reported under all other farm supplies in question 13, and potting soil, which could be included under all other expenses in question 47. Shown here are several expenses that are common to all farms and ranches, be they crop producers or livestock producers. Even operations where all cropland is idle or signed up in conservation programs like CRP are going to have property taxes at a minimum, and there may be a few of these other expenses. Now, the expense information reported in Section H is considered the most important information to be collected on the questionnaire. National, regional, and state level estimates published in the annual Farm Production and Expenditures Report come directly from the information in Section H and are broken down by farm type and sales class. Because of the variability and uniqueness in every farm situation, incomplete information in this section cannot be easily estimated. To that end, if an operator does not provide any information in Section H, then the entire report might as well be considered a refusal. As you're collecting the data and as you're checking your work, you will want to see how the expenses reported in Section H compare to items reported in other sections of the questionnaire. Here are a few examples of the data relationships that should be checked across sections. If debt was reported in Section J, then there should be interest expenses in item 19. Now, it is possible for a farm to have no end-of-year debt and then incur interest expenses if all loans are production loans paid off in the year that they're borrowed. The debt table in Section J should identify any production loans taken out and repaid during the year. If paid labor hours were reported in Section K, question 11, then there should be cash wage expenses reported in questions 24 and 25. The breakout of the labor expenses should closely follow the hours reported by the target operator, the target spouse, other members of the household, and other paid workers. However, be mindful that if the operator, spouse, and partners are not paying themselves a wage, but are rather taking draws from the business in order to pay for household expenses, then wages should not be reported in Section H, and all the work hours would be considered unpaid in Section K. If any land is owned or rented in Section A, someone should be paying the real estate taxes on that land, be it the operator or the landlord. Now, if no one's paying taxes on that land, then include a note to explain the situation. This might also be a time to remind the respondent that any information that they report on the form is strictly confidential. Dairy operations should all have hauling expenses reported in item 29A. If these expenses are netted out of the operator's milk check, then we may need to add them back in order to get the net figure. Also, any vehicles owned or leased by the operation should have registration and licensing fees reported in item 22. When working with operators to complete Section H, encourage the use of farm records. Farm records help to provide more accurate data and shorter interview times. If it's available, the Schedule F tax form will contain some information that could help you in completing Section H, but it will be in summary format and you'll have to split it out for ARMS 3. Shown on this slide, you're going to see items that would be recorded on the Schedule F and the corresponding questions from Section H on the ARMS 3 form. As you can see, repairs and maintenance expenses are listed as one line of the Schedule F, but are broken out as 3 separate lines on the ARMS 3 questionnaire. Of course, this is only a general guide. Use your best judgment before recording data on the questionnaire. In the end, the operator's best estimate is acceptable for responses if there are no records available. Before we close out, let's summarize briefly what we have learned here. All farms and ranches have expenses. On this survey, we are separating those expenses between operating expenses and capital expenses. Operating expenses are those incurred through normal day-to-day business operations, while capital expenditures include those expenses that the business incurs to create a benefit in the future. Operating expenses are generally written off from a farmer's net income in a year because those items or services are consumed within that year. Capital expenses, on the other hand, are made on long-term assets, so are generally written off over time by deducting a depreciation expense each year until the asset depreciates to nothing. Although there's a lot to these sections, try not to get bogged down in the details. Do your best to find a home for each item and record it there. When you're done, ask yourself if the questionnaire makes sense, and leave comments if you're in doubt or if you see an unusual situation. Be careful not to double count expenses in multiple places. Operating expenses reported in Section H should not be duplicated as household expenses in Section M. And expenses listed as operating expenses should also not be listed as capital expenditures. By encouraging the use of farm records, accurate information will be readily available and answering the questions will take less interview time. I hope you found this presentation beneficial. If you have any questions, be sure to consult your interviewer's manual, your supervisor, your NASDA coordinator, or the statistician in charge of the ARMS 3 survey in your region. Thanks for watching, and we hope to see you all very soon.